There's this 200-year-old bank that was more powerful than entire countries. It financed the Louisiana Purchase in America. It helped defeat Napoleon. I mean, it was massive. But the bank ended up losing £23 billion in Argentina back in 1890. When that happened, they were about to collapse. But then London's elite banking community decided to invent something that just never existed before. The financial bailout. I'm talking about the Barings Bank. And the reason why too big to fail has become a common concept in the banking world today. The mechanism used to save Barings Bank all those years ago is the same blueprint that governments have used ever since, especially into the 2008 financial crisis. And guess what? They'll just keep using it again and again. That's why today we need to look into the Barings Bank and how they became too big to fail for centuries. Between 1885 and 1890, Barings Bank pushed more than £140 million of British investment into Argentina. That amounts to nearly £23 billion in today's money. I mean, Barings was one of the most powerful banks operating in the Americas. If a South American country wanted to build a railway or if the US wanted to buy land, the money most likely came through the Barings. Back then, there were no global institutions like the IMF or the World Bank. Nations turned to private lenders like the Barings to fund infrastructure, wars, or even pay workers' salaries. This gave private banks an overwhelming amount of power and leverage. They could influence national budgets, foreign reserves, and even influence how countries spend on public projects. The Barings Bank had enjoyed this kind of control for decades. It may have been one of the reasons why the US became a superpower in the first place. When the United States was still newly independent, Barings took a massive gamble. They backed America when almost every other European banker called it a bad bet. And that decision tied the bank's future to a rising superpower and made it one of the most powerful financial houses on earth. Without the Barings' early investments, America's economic and geographic shape could look very different. Before all that, though, Barings had already been shaping history back home. Back in 1792, Barings shifted its strategy from trade to empire building. Its loans kept British armies marching against revolutionary France. The bank's founder, Francis Barings, wanted to prove that wars weren't going to be won by generals alone, but by bankers behind them. Now, the interesting fact is that Barings himself was personally against the conflict, but still cooperated fully with the government. In doing so, he earned about £190,000 in profit. Adjusted for inflation, that's about £25 million today. That is the kind of contradiction that defined the world of high finance back then and perhaps still does today. Morals can wait, but interest payments couldn't. And this sucker gets better or worse, depending on how you see it. Barings secretly ended up helping both sides. He helped finance Napoleon's Louisiana Purchase deal with the United States, and it was a single agreement that instantly doubled America's size. On the other hand, Napoleon needed quick cash for his European wars, and America needed territory to expand west. So both sides distrusted each other, but they trusted the Barings. The same bank that armed British against France now brokered a deal between its enemies. Now this is ironic in itself, because just like the Rothschilds, Francis Barings ultimately hedged his bets in favor of Britain. His handling of Britain's national debt helped give the empire the financial backbone to defeat Napoleon. As you can guess by now, the bank seized every opportunity it could to make profit and still understood the geopolitics enough to remain on the winning side. From there, the Barings' reach only exploded. Between 1820 and 1870, Barings was writing checks for half of the Western world. I mean, government loans for France, Spain, Portugal, Russia, Canada, and even entire nations in Latin America. By the 1880s, they had become basically the national bank for countries like Argentina and Uruguay. This way, they literally issued multiple loans that kept those economies running. But the irony of the Barings' rise is how it ended. After more than 2 centuries of power, the same institution that often financed wars, nations and revolutions collapsed overnight due to the actions of a rogue trader within the bank. Look, the Barings Bank was too big to fail for a very long time. That part is very true. That lasted for centuries. Look, they evolved over time and their ending was as spectacular as the reputation of the bank itself. You see, long before the Barings dominated global finance, It was a modest merchant bank in London in 1763. The Barons family founded it to tap into the growing trade between Britain, the Americas, and India. But they soon found untapped opportunity in the newly independent South America. London's banking elite were still chasing old money in Europe. The markets were safe, predictable, and promised good returns due to ongoing industrialization. But there was also a lot of competition in the old world. Barings saw an opportunity elsewhere. Argentina and its neighbors were rich in land and resources, and they were eager to modernize. But their tax systems were weak, their currencies were volatile, and their revenues depended almost entirely on commodity exports like beef, grain, and wool. When exports sold high, life was good, but when prices dropped, investors flinched, and the entire system began to shake. This meant that most European banks didn't want to operate in these markets. And that's where the Barons saw an opportunity. They weren't only lending money, they were buying the country's debt and holding it themselves. The bank piled up massive amounts of Argentine securities, many of which no one else wanted. Now, this would have made little business sense back then, but the Barings didn't behave like a lender. The control over debt gave it control over the country's affairs. They basically acted like a shadow government. Through debt agreements, it dictated Argentina's fiscal policy, controlled foreign reserves, and even influenced how public projects were approved. Debt became the leash. Some people in the bank were also starting to ask, was this sustainable? Barings had filled its vaults with Argentine bonds that were actually promises of repayment from a country that was already on the edge. At first, they bragged about holding the future of South America in their books, but when Argentina's economy cracked, those same bonds became dead weight. But to really understand why the Barings reached that breaking point, you need to understand what was happening in Argentina itself. You see, for years, Argentina had been paying its foreign debt in gold, but earning its income in paper pesos. When the export prices dipped or inflation rose, that exchange became a nightmare. To meet payments, the government had to raise new gold loans abroad. Basically, this was borrowing more from the bank to pay the interest on what it already owed. So, between 1881 and 1885, Argentina's government and private sector pulled around 150 million pesos from abroad. That's around $49 million US today. 2/3 of that was government debt, and that meant that a large chunk of the government budget was eaten up by interest alone. Every year, the government owed over 8.8 million pesos in gold, just in interest. Today, in US dollars, that would be about 24 million. So instead of slowing down, they doubled down. In the next 5 years, they borrowed even more money, 200 million pesos. This time, worth about $545 million today. Even though revenues weren't growing, the existing debt wasn't going anywhere. Gold reserves were draining, but the government spending was showing no signs of slowing down. Money poured into railways, new cities, and grand public projects that looked like progress. In reality, most of them produced little to no return. Meanwhile, the Buenos Aires Stock Exchange became a bubble factory. Land prices skyrocketed. Speculation ran wild, and banks kept printing and lending money that didn't actually exist in gold form. So it felt like a boom on the surface, and deep down everyone kind of knew that it couldn't last forever. This is a prime example of a bubble, and when the gold premium rose, the government faced a choice to slow down or to print more, just keep digging themselves deeper into the hole. President Miguel Juarez chose a second option. By 1887, gold supplies were already running low. Despite this, he extended the suspension of gold payments that had been meant as a temporary fix in 1885. On top of the economic pressure, Argentina's political condition was getting worse by the day. By the late 1880s, inflation was rising, corruption scandals were piling up, and public trust in Miguel Juarez's presidency was collapsing. Another major problem for the Barings came in the form of a project that was supposed to symbolize Argentina's modernization, and that was a Buenos Aires water supply and drainage loan. This looked great on paper. Clean water from a booming capital financed by one of London's most prestigious banks. To London investors, this infrastructure was proof that Argentina had joined the modern world. For Barings, it was a flagship deal that symbolized trust in the entire country's future. What could possibly go wrong? Well, pretty much everything. The water supply and drainage company completely misjudged the scale. They built half of what was needed and still expected people to pay for something that barely worked. By October 1890, customers owed about $1.65 million in unpaid water bills. That's about $58 million today, when adjusted for inflation. And yet, the company still had to pay interest to the bondholders and meet installments to the Argentine government. By now, the pyramid scheme that the Barings had tried to build up didn't work anymore. It couldn't sell new shares to cover the gap. Investors were scared, and by admitting that the Argentine economy was on the verge of collapse, would be even worse for the bank. So, they just kept bleeding money to keep up appearances. The crisis soon rippled through the Barings' entire Argentine portfolio. One example was a Curamalan land company. It covered nearly 600,000 acres, which was one of Barings' biggest real estate deals. But even that massive project soon began to fall apart. The Barings had floated its mortgage bonds in London, but as the economy crumbled and the funds were misused, the company defaulted in November 1890. They managed to settle the mortgage in 1905, but the land wouldn't be completely sold off until 1929. Nearly 4 decades after the initial collapse. But because this loan had been underwritten by the Barings, every peso of loss hit them directly. And that loan wasn't small. It made the Barings dangerously exposed to Argentina's growing instability. By the mid-1890s, the frustration boiled over. Soldiers joined civilians in the streets under a movement called the Revolution of the Park. It took over Buenos Aires Artillery Park and called for the end of Miguel Juarez's presidency. News of the uprising traveled to London by telegram and sparked an instant panic on the trading floor. If the government couldn't control its capital, investors assumed that it couldn't control its debt either. Even though the revolution was put down, Argentina's credibility was already shattered. However, some investors believed that the future debt would be honored. Bond yields shot up as investors demanded huge premiums to hold Argentine debt. Prices collapsed on the Buenos Aires Stock Exchange and every foreign capital fled the country. By the end of 1890, Argentina defaulted. The nation stopped servicing its foreign debt and was cut off from global credit markets overnight. For Barings, the default was a direct hit. The bonds that they had underwritten, the loans that they had guaranteed, the promises that they had sold to investors all collapsed together. The shock didn't stay in Buenos Aires alone. It rippled straight into London, one of the top financial hubs in the world, where the Barings' collapse threatened to pull everyone down with it. You see, in London, the scale of the problem became undeniable. When bankers in London began reviewing Barings' book, disbelief quickly turned into alarm. By October, the number on Barings' books looked catastrophic. The bank carried about £15.7 million in liabilities, about £2.1 billion in today's money. It also held £8.3 million of worthless Argentine securities, roughly around £1.1 billion adjusted for inflation today. That was almost half of its balance sheet. Credit evaporated, interest rates spiked, and the once confident city began to panic. London's credit lines tightened, and the bill markets froze. Every firm began guarding its gold like war had broken out. Everyone realized the danger. Barings' obligation linked it to hundreds of companies, and obviously failure would send shocks throughout the financial system in London. Banks would face defaults. Markets could seize up. Business activity would stall. The fallout could threaten Britain's entire economy and shake confidence across Europe. So the governor of the Bank of England made a move. He sent a discreet note to Chancellor George Goshen to urge him to come to the city, and Goshen didn't need convincing. He wrote back saying that compared to what was coming, the panic of 1866 would be a trifle. And he wasn't wrong. The countdown had begun. The Bank of England's gold reserves had fallen significantly. To buy time, Bank of France stepped in. It swapped $3 million in gold for treasury bills while Russia added another $1.5 million. Combined, this sum would be equal to £160 million in today's currency. With this lifeline secured, the bank could finally face the crises head-on. Altogether, the Bank of England assembled around £17 million in rescue funds at the time. This amount was further guaranteed by London's leading financial houses. So, a financial bailout, if I've ever seen one. And it was on charity, because every major house that joined the rescue for the Barings wanted to save themselves. They knew that if the Barings went down, they'd be next. Now, The partners in the Barings Bank had no choice but to sign over their personal wealth to keep the firm alive. This included their homes, real estate, and even art collections. In the end, the wreckage of this bad bank was sold for $1.5 million, roughly $53.4 million today. The episode changed banking behavior across Britain. In the immediate aftermath, bankers became more cautious. But this caution was temporary, as you can imagine, because in the grand scale of history, the bailout sent a completely different signal. And that was if your collapse threatened the system, others would step in to save you. Risk would be rewarded. For a while, the survival felt like a victory. The Barings survived and their confidence returned. But the rescue carried a hidden cost. It was the first coordinated financial rescue in modern history, the private-public lifeline for a single bank. And it set the template that every future crisis would quietly copy. The Barings survived not because it had been disciplined or markets had corrected themselves. It was saved because London's financial elite helped to pull resources, signing secret guarantees, shielding the bank from the full weight of its own recklessness. Public accountability was weak. Much of the rescue was operated in informal agreements and reputation rather than law. Although the Bank of England was private, it now took on a quasi-public role. This bailout proved that if a single bank's collapse could shake London, then the system itself could no longer be trusted to police its own greed. From this bailout, the system learned the wrong lesson. Instead of punishing reckless lending, the bailout rewarded it. Future financiers realized that as long as their collapse threatened others, they could expect government protection. When Barings was rescued, economists hadn't yet coined the phrase moral hazard. But that's exactly what it was. I mean, a signal to future financiers that some institutions are too vital to fail. The term later came to describe the comfort of risk without consequence, where losses were socialized but gains would stay private. Look, if you strip it all down, the Barings' crisis was really just a warning. It was a clear message written in debt and denial. It showed that global finance could hold nations hostage, and when greed meets weak regulation, collapse becomes inevitable. If you've made it this far, leave a dollar emoji in the comments below and scan this QR code to get access to my Substack newsletter. These videos are published early in my Substack newsletter, so subscribe today and subscribe to the channel if you haven't already. Also, check out this video that I made about Jesse Livermore. It's a fascinating story, and I'm sure you'll enjoy it. Thanks so much, and I'll see you on the next one.